Good morning, my name's Michael Harding, student number B9009969. My category of assets is property, and my client's tolerance to risk is risk neutral. So there's many different ways that my client could invest into property, and the first method I'm going to look at is purchasing a property for appreciation. So this is outright owning any type of property in the hopes that within the next few years the property will increase in value, and my client will obviously make money off of the sale when the property is sold. Property can then further be subdivided into residential and also commercial properties. So a few examples of residential properties are one-bedroom properties, also single-family homes, vacation homes, often a good investment if chosen in a prime location. And then if we look at commercial properties, we have multi-family properties such as large apartment blocks or anything along those sort of lines. And then we also have retail units, such as you could look at units at Meadow Hall that would obviously be commercial retail units. There's also office spaces, and we could also look at outright owning land. So how could my client make a return on investment on a one-bedroom property? Well, one-bedroom properties are normally the cheapest, and this is because they have the least amount of space within the property. So they normally require the least amount of capital. So looking at this one-bedroom apartment I found in Sheffield city centre with a postcode of S12EG, it's currently being offered for £115,000. So by dividing £115,000 divided by the total square foot that's within the property, it gives us a price of £270 per square foot. This can then be used to compare against other properties within the local area so that my client knows whether they're overpaying or underpaying for a property within that location. The UK house price index in 2020 was 7.6%. The year previous to that it was 2.2%, and the year previously to that it was 2.5%. So if we take a 3-year average over the last 3 years, it gives us an average of 4.1% growth in the UK housing market. So then we can look at what we get as a return if we invested into this property over a 5-year period. So we can see that profit over 5 years should give us approximately £25,000. This would give us a return on investment of 22.25%. My sources for this property, I found this property on Zoopla, and I've also used Office of National Statistics to give me my UK house price indexes. So what potential risks are there with investing in a one-bedroom property? So the capital is not accessible to the client over the period of investment. So that £115,000 that's required to purchase the property cannot be accessed by my client until the property has then been sold. The housing price index average is not guaranteed over the next few years. Obviously, if we've only taken an average of the 3 years, it could be seen that to have negative growth in the UK over the next couple of years, and my client could potentially see a negative return on that investment. However, it is fairly unlikely that over a longer period of time to see an average negative growth, as the UK housing market previously has always seen growth over a long period of time. There's always hidden costs in purchasing property that may not be aware to my client before trying to make this investment. There's normally some legal fees involved with purchasing property, and the property may require capital to be fixed whilst the client owns it, so there could be issues like boilers or electricity that obviously then require my client to spend extra capital in order to bring people in to fix any issues. There's also stamp duty when houses are over a certain price, so my client may have to pay some stamp duty on top of this investment, and those are the associated risks with this investment. The second way my client could invest into property is through buy-to-let. So by looking at the same property we've just looked at, rather than requiring £115,000 to outright buy it, my client could use a mortgage. This will require a lot less capital and could only require 30%. So using 30% deposit as an example, this requires £34,000 of capital. And the repayment term of the mortgage is 20 years at an interest rate of 2%. So the property could be leased for approximately £140 a week. Obviously, this is not guaranteed, and this is speaking from personal experience. Looking at properties in Sheffield, I found that a luxury apartment such as the one found could be quite easily rented for £140 per week. This would mean that it was £550 a month, minus obviously your cost for the mortgage. You're looking at approximately £141 of profit per week. So over a 5-year period, this would give you £36,660 over 5 years, which is a return on investment of 107.82%. The sources for the mortgage calculator again was Zoopla, at the same place where I found the property. Some of the risks with this investment is again the property prices may decrease over the period that my client is renting out a property. There's always a risk of repossession. So if my client lost his source of income to be paying the mortgage, so say that the tenant wasn't available and he couldn't make the mortgage repayments, then there is obviously that risk of repossession. Like previously mentioned, there may be periods of time, or it's very likely that there are periods of time when the property doesn't have a tenant. So without that tenant, it is then on the responsibility of my client to 100% make sure he can make those mortgage repayments. Obviously, the mortgage is required for 20 years. It's a long-term investment. Obviously, it depends on how long my client would like to be invested for. Down payment, obviously that £36,000 will be tied into the property until it's sold. So then another method or another potential area my client could invest into property is through individually picked stocks. So an example here, I found a company called Brookfield, Canadian Brookfield, and over the past year they've had the highest value of assets compared to any other property developers that are publicly traded. So their current assets are $324 billion US dollars. They had a revenue of $69 billion US dollars in 2019, with a profit of 2.8 billion, a market cap of 89 billion, showing they have extremely high liquidity. So 5-year previous returns are 112.8% as it stands. This was taken, so their current stock price is 56.51 Canadian dollars, and in 2017 it was 26.9 Canadian dollars. So that's how I've calculated the ROI on this investment. So if my client had invested £10,000, looking at the ROI there, it would have paid them out 21.28, and that would have been a profit of £11,280. Sources I've used here, Forbes, they gave me the revenues and profits, but then I've also used Yahoo Finance to work out the stock prices and the picture that's used on my right. So obviously there again come risk with this type of investment, and I think the biggest risk for me is there is absolutely no diversification of my client's portfolio. By investing all into one stock, it does take on a high amount of risk. There's absolutely no guarantee that the company would continue their previous growth. So just because we've seen that return of 112% over the last 5 years, definitely does not mean that we'll see those returns over the coming 5 years. There's also, again, higher risk than fixed income properties, fixed income returns such as buy-to-let properties. There's also brokerage fees involved when buying stocks. So I personally recommend to my client to use Interactive Brokers. They're the brokerage I currently use, and they offer some of the lowest fees in the world. And my client would also be subject to capital gains tax had they made a profit. That's again something they might want to consider whether they would actually want to invest into these stocks. So another method of investing into property is real estate investment trusts, or also called REITs. So we can look at a REIT here, which was one of the highest performing REITs over the last few years. So real estate investment trusts are companies that own income producing real estate. So it could be in commercial or residential property, or sometimes or often a mixture of both. It's similar to an index fund in terms of it's a lot more diverse. This one company is normally investing into many different types of property rather than just one. And that's how my client is exposed to a more diverse portfolio. So the 2020 price of IIPR was $180.29. 2016 price was $21.35. So this is a 5-year growth of 49.1%. So if my client had invested £10,000 5 years ago, they would now have £84,910. This gives a profit of £74,910 and an ROI of the 849%. So the source I've used for this firm's financials is Yahoo Finance, and a little bit of information has been found from Motley Fool on stock REITs. So what are the risks associated with REITs? So when interest rises, the demand for REITs decreases, and subsequently price action can move bearishly. Also, selecting individual REITs can be risky as they might not perform to expectation. There's no guarantee that just because they have performed well that they're going to perform well in the future, and just because the REIT I'd selected had performed very well over the last few years compared to other REITs, is absolutely no guarantee that it will perform better than other REITs in the coming years. Dividends are also taxed as ordinary income, opposed to dividend tax rates or capital gains tax. So it could mean that my client would end up paying more tax on this investment product. And lastly, another method to invest into property is through property investment bonds. So these are bonds that are being issued for the purpose to raise funds to invest into real estate. So an example of this that I found are Carlton bonds, and you can invest here as seen with the IFISA, and this is legally binding, so the company should always pay out the bond repayments. You can often be found from between 5 to 12% returns on property investment bonds. And obviously, as you can see here, the Carlton bonds are aiming for a 7.75% return per annum. So this would give a return on investment over 5 years of a profit of £4,524. So again, the money is tied into the bond until the bond expires, meaning my client cannot access their capital. There's always a default risk that the company may not be able to pay out the bond repayments. And there's always inflation risk with bonds as well. So what current economic risks are there associated with property investing? So obviously over the last year, almost year and a half, we've had the global pandemic of COVID-19. We still can't be sure how this might affect the housing market. It may potentially be that less people are looking to move and the housing market becomes quite stale. There could also be a change in government regulation. This can often affect property and purchasing property investments. If unemployment was to increase, then property houses could decrease quite significantly. There's also a currency risk, so if my client chose to invest into a vacation home that was in another country, not domestic to the UK, if my client was from the UK, then there's always the risk that the currency depreciates and the value of investment lessens just because of this. And then there's also concentration risk. So this is having a not diverse portfolio. So if my client was to invest into a single one of these methods, then they would be undertaking quite a high amount of concentration risk. So what would be my personal recommendation for my client? My client is risk neutral, meaning that they wish to take a medium amount of risk for a medium return. They're not looking to take additional risk for additional returns, and they're not looking for safer investments for lesser returns. So considering this, my personal advice to my client would be to invest into a buy-to-let property. It requires less startup capital for decent returns over a mid-term period of investment. However, this would not be my only recommendation. Just because my client wishes to remain risk neutral, I don't believe that my client should only take risk neutral investments. My personal advice would be to split their portfolio into a 10-20-70 split. 70% of their capital being put forward to that risk neutral investment of buy-to-let properties, 20% to be invested into property bonds, and 10% to be invested into property stocks. The reason I believe this would be the best case for my client is because although they are risk neutral and are not looking to take additional risk, by applying only 30% of their portfolio to slightly riskier investments, so 10% to the stocks and 20% to the bonds, it means that if there was a period where my client didn't have a tenant or couldn't pay for property development costs, say like I previously mentioned about a boiler or electricity going wrong on their property, these investments should cover, should help them make some returns at a period where if there was no diversification of their portfolio, they would only be making income from one stream. So by diversifying it into 3 different streams, hopefully it should protect against a lack of diversification.